I mean, 21,000, can you imagine for a market which was struggling to cross even 19,500? Now we're looking at 21,000, and I don't think we are done yet. Uh, global cues are also favorable. FIs are back. The underperformance in banks is getting checked. Now, the market action is clear that big institutional investors, big HNI investors, they're simply taking a leap of faith now. While we can talk about Nifty at 21,000, banks making a comeback, there is also a rotation which actually started in small and mid cap stocks, and that's something which we'll talk about as we go forward. So in this market, if you're bullish, well, you have to respect the trend. The mistake what a lot of people do when you are in a grip of a very strong bull market is that you try to be cute, you try to time the bull market, which is that, okay, you sell, you buy, but you sell quickly in anticipation that markets will come down and you will participate again. So in this kind of a trending bull market, just stay on the course. Markets right now are going through an extraordinary bout of momentum and an extraordinary comeback by global institutional investors. So I guess the best strategy in this market is just stay on course. Large cap stocks and especially banks are in a good groove, and you want to be in that space and you want to maximize this kind of an setup.
Yeah, but I think for investors who were in any case fully invested, I guess they've made a killing. But those who were underinvested and now are feeling the FOMO that maybe I should buy in now, I think the bigger debate is that.
So Aisha, look, if you let's assume that you were waiting, you were on the sidelines. You were worried because of the political landscape as to what will happen to the state election verdict, or you in a sense did not participate and you were afraid of a sell-off. So the FOMO effect has definitely kicked in. But even if you jump in now, let's look at the realistic picture. Even if you jumped in now, and if you buy large cap stocks, I think large cap stocks still have potential to giving you a double-digit return in 12 to 18 months. Equity in the long term has generated returns anywhere between 11 to 14% depending on the patch which you track. So if you're feeling FOMO, and if you've ignored the channel advice of not selling and staying invested, then today also if you jump in with a slightly extended time frame, and if you buy large cap stocks, select banking names, select private bank names, some manufacturing names, couple of consumer names, the markets are not terribly expensive. There is no bubble in the market. So it is not that the train has left the station. Yes, there are small and mid cap stocks where you really need to be careful, and I'll just emphasize on this part here. So let's look at what is happening in the market. Suzlon from the 52-week high, JP Associates from the 52-week high, Reliance Power from the 52-week high. Some of these stocks have already started turning. So that is Suzlon for you yesterday. But from the recent 52-week high, Suzlon is down more than 10%. JP Associates from the recent high, the stock has reversed completely. So that's 40 the 52-week high for Suzlon. From there it has come down to 39.5. Similarly for JP Associates, similarly for Reliance Power. There are a lot of rank mid-cap stocks which just went up because of a hot air phenomenon. They've started reversing. So this is where I think markets are telling you that if you miss the rally, it's okay. But if you want to jump in, you don't want to jump in on these stocks. You want to avoid small cap stocks. You want to avoid some of the rank mid cap stocks. The margin of safety is there in large cap stocks, and which could be a happy hunting ground for next couple of days.
Yeah, happy hunting ground indeed, given the fact that we have seen the likes of the heavyweight banks, the likes of Reliance Industries as well, perking up. But the other factor that the markets will have on their mind, I mean, Nikunj alluded to a number of positives, and then there's the GDP print, and that, of course, is going to be fairly, the RBI is going to be cognizant of that. Remember, they're preparing now for their 3-day monetary policy committee meeting that starts today, and the expectations are rife that the central bank going to maintain a status quo on the repo rate, so leaving it unchanged at 6.5%. That is what the ET Now poll is indicating. And by the way, this will be the 5th consecutive time that the MPC is likely to keep the interest rates on hold again, and that's largely on account of the upturn in growth in the GDP print as well, Nikunj.
See, Aman, from a market standpoint, I think this time's credit policy purely from an rate standpoint is going to be a no-go. I don't think anybody is expecting anything very meaningful there. The GDP data has surprised everybody. commodity prices have started coming down. So growth is on track and inflation is coming down, and liquidity in a sense is now manageable. So I think the setup, at least on a macro standpoint from a Reserve Bank of India's standpoint, is not very troublesome. However, the chink in the armor, I think, is what everybody would like to understand from Reserve Bank of India, that why 2 weeks ago they came out and they really raised a red flag for unsecured loan. Is there a trouble which Reserve Bank of India is spotting in the unsecured loan book? One. Second, what is the read of the rural economy? If the GDP print is strong and if government spending is strong, then how are they viewing the K-shaped formation of the economy, and do they really see a recovery happening there? And see, could it be problem of plenty for Reserve Bank of India going forward? Suddenly flows from FI front, FDI front, bond inclusion, all those factors would be at play in 2024. So how are they really preparing themselves to manage the market risk and the market volatility? That was the status in the last credit policy meeting. Crude was at 83, it's come down to 78. The 10-year paper was at 4.7, it is at 4.2 now. Inflation, that's the Indian 10-year yield, 7.2, 7.3, that's okay. And inflation directionally, I think, is going lower. We are no longer crying for onions and we are no longer crying for tomatoes and potatoes. So things are manageable now. And sometimes Reserve Bank of India just gets everything. I think you are in that stage. The narrative, the faith, the macro, the landscape, the liquidity and the inflation. So touch wood, but this is like a great scenario. If you are an RBI governor state, you would say, okay, what can I say? I mean, I just need to...
I just have to sit back and
Exactly.
manage the
Exactly.
narrative.
Just manage the liquidity,
Yeah.
make sure that there is no bubble in the unsecured loan category, and the rural economy actually comes back. I mean, if this setup continues for next couple of weeks, then 2024, it could be problem of plenty rather than problems of scarcity.